Okay, so thanks a lot for joining today. I'm Giuseppe Basile, also known as the FIB Stalker. I'm a premium contributor to FX Trade. I also contribute to the Canadian Society of Technical Analysts, and I founded FIB Stalker Trading. So today I'm going to talk about smart money, dump money, and seasonality in the current markets and look a little bit at the current moves in some of the markets. This is part two of a presentation that we started. We actually done on in July. So if you're not with me that day, please review the presentation as well. Okay. So very quickly, everything I say is a lie. So, so to speak. So always double check, verify, do your own analysis as well, and I always ask followers and also the attendees to double check and verify for themselves. So and basically this slide says that if something goes wrong, you cannot sue me. So that's the whole purpose of it. Just briefly about myself, I'm a computer science engineer by background, and also have a master's in finance. I hold a master's in finance and certified market technician in 2012 with the SIAT, which is the Italian Society of Technical Analysis, and it's part of the International Federation of Technical Analysis. I started in 2000s. I had this mission of solving the markets. Obviously, I could never have done this alone. And I worked with a number of mentors, among them Vantar, Pivica Jurasits, David Asley, Judy Napoli, some of the people I've worked with and whose work I've studied. In 2012, I launched the FIB Stalker Trading. I have a free newsletter, and I'm resuming the FIB Stalker analysis and trading service this September. So if you're interested, you can go to fibstalkertrading.com and have a look at that. So this is some of the collaborations I have. I'm also very active in research as well, and actually, I was awarded by the CSTA, the Canadian Society of Technical Analysis. I was awarded the prestigious Jack Frost in June this year, and I was very happy. I was not expecting this, and I want to remind the importance of timing. That what Jack Frost said. Jack Frost is one of the founder of the Canadian Society of Technical Analysts in 1982, and is also a big, huge contributor to the Elliott wave theory. So technical analysis is somewhat like sex, timing is everything. So if you want to be part of the community, it's a free course. You can go to this address here, winningwithalgos.com community. And let's get into the content. These are my contacts if you want to contact me, fibstalker@gmail.com and fibstalkertrading.com. So let's get into the content here. So in the first part, we actually review the two market players, who they are, what I call the smart money and the dump money, and they're both useful, very useful. Sometimes the market is pushed higher or lower by the participation of dump money. Other times it's smart money. When they come together in a trade, then you have a very powerful trade. I'm not going to repeat this. Smart money, people who know what they're doing. Dump money, people who follow, who use simple technical analysis tools like the moving averages. Moving averages can be very useful in certain conditions. What I believe is that in order to win this game, we have to stop the smart money, because the dump money will always follow or will always be late. Okay, so we spoke about algorithms. We gave some facts about algorithms. You can review the first presentation. And in that presentation, I also spoke about how I model important classes of algorithms And I also gave two simple models. We also spoke about the levels, Fibonacci level I use, and these are the only one I used. All the others I actually don't use them because there's a better explanation for them. So again, if you want to know more about how I selected these numbers, there are a number of works you can look at. Particularly, there is in May 2014 a traditional and new uses of Fibonacci in modern markets. You can review that presentation, and gives you a pretty good idea why these numbers are important. Of course, as usual, if you have any questions, please write them down. I'll be very happy to answer them. So these are the two models. I'm not going to talk about them again. There are many presentations on FX Sheet where I speak about these simple models, and they're very, very powerful. And when I introduce this to people, people come back to me usually saying, it's unbelievable how well they work. And we're going to look at some examples. We talk about the psychology of the market, how this shows up on the long-term charts, and how modern algorithms basically use the same rules that you could have used in the past to capture the low in 1974 or the low in 1987. And all this you can review in the previous presentation. Spoke about where the SP 500 is going, keeps going to that second target, which is this 2400, but the last update is 2560. So that's the 2550. That's where the SP 500 could be going at the moment. Okay. So I want to talk now very briefly about seasonality, and then we're going to look at the way we model that money. For seasonality, you can use simple tools. There are some free charts on equityclock.com, and basically you get charts like this, whereas you have the months and the percentage of gains or losses that you get in average in a large number of years, you get in the different periods. So as you can see, when we look at the Japanese yen futures, this market seasonally goes up from April to October, which means that the US dollar Japanese yen, on the other hand, does the opposite. And in a way, we have been seeing that in the last few months. We'll look at the charts in a minute here. But the point of the seasonality is that you cannot just trade out of seasonality. Someone describes seasonality like a breeze, like something that can push the market in one direction or the other based on seasonality. Can help the market moving in the direction of seasonality, but of course there has to be a stronger risk, there has to be a setup, there has to be smart money or dumb money actually pushing that price lower or higher. So let's look at charts here. I'm looking at some of these markets here. I was hoping to for a bounce before the move lower in the euro pound here, but that's not what I was looking for. I'm looking for US dollar Japanese yen here, and it's a very good technical market here. And in a way, from April, when we look at the daily time frame here, you can certainly say that seasonally, this market has had a downwards bias, but the reality is that smart money and dumb money made a much better work in modeling this market. So let me analyze this market for you to show you where we are at the moment, and for now I'll use smart money, and I will use those two models. So if you're not aware of them, you can review them after after this presentation, but the model is very simple. I will start just for simplicity from the high in July 2016. Here we had a first 50% retrace here, and the market went to the first and second target here, and therefore that allowed us to use our rules and trace from lows to lows, because when the market gets into the second target is extended, so we trace from low to whatever new lows after the target is hit. As you can see, the next setup came at 1180 area and was just spot on. The market got into that first target that was profit taking, so the market came back, and because he only hit the first target, we used our rule and we traced from the same anchor to a new low. And as you can see here, because this market is very technical, meaning that it responds very well to the Fib Stalker levels and the smart money, the way I model it, the market again found participation around this area and hit the first and right into that second target. And that's where we got the reaction there. Now, it's not a case the market broke here. When we traced the next measure move, at some point it broke. As you can see, the 61% level was pierced on the upside. Don't worry about the moving averages. I'll explain them in a minute when we talk about the dump money here. And the market broke here, but you always have to put the price in perspective, and we have to look at the reason why it broke. And there is a reason it broke, because on the larger time frame, this is the weekly time frame, the market came and tested the 50% retrace here. That's what you see. That's what you see here. So the market broke because there was participation on the much larger time frame that pushed this price higher, and that push higher was enough to break the sequence of measure move lower here. Okay, once that's broken, it means that the participation on the downside, it's not strong enough to win the participation on the upside, which means that we have to anticipate a move higher. So that's exactly what happened, and later on I'm going to talk about smart money, how it came in play, and how important it is to act when you have bought smart money and dump money signals together. So this market started moving higher here, and it was very extended, and it went to break the back of the larger shorts, because what happened is that he has not even reacted around the 50% short here, just went higher and eventually broke the 61% level. This is long-term bullish, obviously, because it means that there is nobody here pushing the price lower. Okay, so welcome, Jerry. So we are looking at the I don't know if Jerry can hear me, but we will wait. And so this price broke on the upside, which means that now there was no interest from bears on the weekly or monthly to push this price lower. I'm talking about smart money here. I'm not talking about dump money, okay? However, the market moved lower. The fact that the smart money does not have interest in selling this market does not mean that the market cannot be pushed lower by lower time frames or any other actors in the market. That's what happened here for some reason, which we don't know, and we don't have to know. To be honest, I don't want to know, and I cannot know everything, any reason why the market was in certain. In fact, sometimes there are no reasons. The industry tries to attach significance, semantics to how the price moves through news, but the reality is that we don't know. So the best we can do is actually do our best to understand where are the areas where price can turn, and then time the turn. So what happened here is that the market came back to the 50% long now, and there was participation, and the market became range bound. Imagine from where to where. Now you start understanding how we use these models. Okay, so there's participation at the 50% long, but there was also participation at the 50% short. And as you can see, this market remained range bound, and I believe it's still range bound. We have not pierced the 61% level. Okay, so that's where we are in this market. So if I had to project where this market is going to go and write my words, in the past, remember in 2016 here, everybody was saying when they saw these 2 weeks of move higher, SP 500, the US dollar Japanese yen is going through 131 and so on. I was saying, wait a moment. So we have 50% short here. The trend higher had broken. I'm not going to show you that, but had broken, and also we have condition from dump money here. Okay, so if I had to project where this market is going in the short term, this market might be going to retest these upper levels here. That's the 113.44. Okay, now there is dump money here on the weekly, and I'm going to explain that in a minute. But that's where the market could go. More on the intermediate term, you would see this market back to this 118 and even higher. So we will see that, of course, implies that the US dollar is going to bounce. We are not sure about that. That's what this chart is telling us. Okay, and in October, as the seasonality starts moving lower for the Japanese yen, actually that seems to imply a potential boost for US dollar Japanese yen. Again, doesn't mean that this is just breeze, seasonality, doesn't mean that it will play out like this, but obviously if there is a setup, and at this point we still have this setup long, then the market can move higher. Okay, so the first target of this setup here is the 123.25. Now enter dump money. Okay, if you want to also look at the past calls on this market, US dollar Japanese yen, I'm giving you all these reference here, which you can actually use. So these are links at YouTube to YouTube. You can review either my own reviews or these are links to actually other presentation like this, so you can review them. The calls, so there were some calls were and setups that actually presented while I was actually presenting. So this for accountability for the previous calls. I also showed you the analysis I just showed you the analysis also. I remember there was one particular call. This happened while April 26 and 16, while I was holding a presentation like this in the morning. So you can review this in the recording. You can look at the addresses. So let's look at dump money. I model dump money with moving averages, and the meaning when you look at moving average, what's the meaning? Is the price consensus of value at the moment of a trade. Sorry, price is the consensus of value at the moment of a trade. So a moving average, on the other hand, reflects an average consensus over the period of the moving average itself. So what is the information that we get from moving average? The slope identifies the direction of change in the public mood, and the proximity of price to the moving averages differentiates two types of trader: the value trader and the greater fool theory trader. Okay, when the market is close to a moving average, you are trading value. That's because the market tends to retrace to areas where the moving averages are. So regression is called regression to the mean. And if you are trading away from the value from the moving average, then if you're trading, you can be a reversal trader, or you can be a greater full theory trader. And so to me, it's always good to trade value. So take position when you're closer, when price is closer to the moving average. So what's a value area? It's the area between two EMAs, and I use 1326 on the chart. You see 10 and 30, so you can basically play. I think 10 and 30 are better. 10 reflects better the smaller time frames. So if you buy or sell close to these AMAs, in the area between these AMAs, then you're trading value, and a lot of dump money trades value. So that's why sometimes we get certain bounces or reactions around this value area. So most players buy sell in this area and price bounces. So that's why I want to know where these areas are. And even if they don't work precisely, whenever the lower MA is below the higher MA, then it's a bearish condition, and vice versa. Okay. So here I have an example of the SP 500 mini and also an example of seasonality. I'm not going to get into seasonality for the SP 500. You can review it yourself. What I'm going to do, on the other hand, I'm going to review the dump money on the weekly. So we say that the area between these two moving averages is actually an area of value. Now, this applies to all time frames, to weekly, daily, 4 hour, 1 hour, and you name it. And as you can see, visually, you can see that every time this market gets into value area, there is, not always, there is a reaction higher, until there isn't. When the value area changes, this is a short value area, so I'll use green for short here, short value area, right? Short value area, short value area, short value area. And again, short value area. Now we have a short value area here. So the market is rallying into that area. How that is going to play out? The fact that there is a short value area doesn't mean that necessarily the market will always correct. We also have to consider what the smart money is doing. And here the smart money apparently still supporting this price, because the price did not break the 61% level. Okay, so the beauty is when, as I mentioned before, smart money and dump money, they agree, and that happened a lot here on this move lower. For example, here there was value area, price went well above the value area, but that's not important. What is important is that you want to trade a very important 50% short. So you have the 50% of the Fibonacci level here, plus you have the condition of the dump money. So when that happens, you see a move lower, and you have to be very aggressive when you see this, because there's opportunity for bigger profits. That said, you should always mind your risk, because as traders, risk management is our job number one. But in this move lower here, as you can see, there's another condition where dump money and smart money agreed, and that's again when smart money and dump money agreed, you see very quick long moves again here. And again, in the other signal I showed you before, the lows to lows again, dump money, smart money agreed. Okay. Now, interestingly enough, there is a situation where now smart money it's long, as I showed you before. So here, sorry, trying to annotate. So here, smart money is long, but dump money is still seeing a move lower. Can you see that now we go back to what we said before, right? So who's right? Smart money always proceeds. They take positions in spots where it's difficult to take a position. It's very difficult to take a position when you see this huge move lower. And what that money is looking at is the moving averages in the current trend. They say, well, the current trend is still low, it's still down. But they don't understand that smart money here has started trading this market higher. And whenever this breaks, buy shorts, right? Because now smart money long is in control. The point is that money still believes that this market ought to go down. What they do, they short it here, which could be an opportunity for a brisk trade lower here. Can you see here the difference though? The difference is that in here and here and here, smart money has agreed with dump money. Dump money is always driving the game. In here, it's the first time where smart money goes up, goes long, and dump money sees still the short. So can you see that dump money is always a follower? So what happens is that the market gets into again this area and is pushed higher by smart money. Dump money pushes down again because, as you can see here, price re-enters these conditions here, re-enters this value area, until when this value area does not work any longer. Okay, and this is something that it's now happening in a way, in a smaller scale. It's happening here at this 50%. So the smart money is keep pushing this price higher. Will the dump money here be strong enough to keep pushing this price lower? That's a big question there. Okay, so that's why you have to try to take a position here and make it a freeze trade and then see what happens, because we don't know the future. Okay. Now the beauty is that when you put together this information on all the other time frames, you get quite a pretty and good picture of what's going on, and you can take trades. You can take trades within these trends as well. For example, when this market continued moving lower here, we knew that the first area where we were to look for a potential participation was this 108.77. Why? Because this is a 50% change. But if you look closer here on the daily time frame, you had dump money shorts, which means that with the overall information you have, knowing that there's a 50% here, you know that there is still some room to go here in a trade. Okay, so knowing where this area of dump money are, it's very, very important. Of course, you cannot do all the time, not on all time frames. For example, here the dump money was never clearly tested. So it's a bit risky to take a position here before the dump money area is tested. But because this market stayed in this range, what happened here again? There was another opportunity. Here, this market was moving lower, and there was an opportunity for another trade. Here, there was an opportunity for a test of the 50% level. In here, we had participations at the dump money long. Okay, and we can repeat this in this move lower. Participation. Even if price goes above the value area here, there was that push there. Who's in control though? Smart money is always in control, and we say that in one of the slides here. I want to repeat this concept because this is very, very important. Okay, so there are two market players. Smart money and dump money. Smart money knows what they're doing. Large bank, professional traders, program trading, algos. Dump money, additional tech analysis crowds, trend following, discretionary. And I don't have a clue of what is this, but it's trading big and is cool. So smart money and dump money don't win or lose at all times. Sometimes smart money loses, but smart money initiates and leads market moves. Very, very important. Dump money obstacles or follows market moves. So often it's either wrong or late and lag price. So that's why we always want to follow the smart money here. Smart money means trading like some of the modern algorithms trade. Okay. Do you have any questions on this? Is this clear why and how we use these moving averages? Now, again, this is the 4-hour time frame here. You can look at this dump money area on all time frames. It's not a case that you have this kind of reaction here. Obviously, this kind of reaction needs to be within a framework of reference, knowing that smart money wants this price lower. If smart money wants this price lower, whenever you have situation like this, you can manage your risk to take a profit out of the market. Okay, and in some of these move lower, there are many of these opportunities, and whenever it's not a 4-hour, it can be larger time frame, the smart money, dump money signal. And so you can take advantage working on many time frames. Okay, so so this is really the overall message that I wanted to convey in this presentation. And are there any questions in relation to this? The way we can use smart money and dump money. Smart money being represented by the Fibstalker levels. Jerry, John, Mark, Nick, Pat, Tom, any questions? If you have any questions, please write them down. And what I'll do in the meantime, I'll provide here an example and explain the Fibstalker timing. And this is related to the timing of the July 2015 call on the long on the SP 500. So when we look at the charts here. And this market continues moving higher. When we look at the chart, we're talking about the July 15 15 call of the extension long here. So all those models, smart money that I presented to you, they actually hold on the SP 500 as well. And in July 15 here, there was a call in relation to the this moving up to this the trace here. So in October, the market had traced. Let me remove some of this. So in October, the market had traced into this area, the 1755 here, and went to the first target. So the way we captured, and that's the call, it's related to this, the way we captured the next measure move was this one. Okay, so first of all, how can we model the moving average? There's always a 50% level, and there is a sequence of measured move on the downside into that level. If there is participation around that level and the sequence of measured move breaks, then you want to go long in this case, or short if it was a short. The shorts, they work exactly the same way. Okay, so you can look at September 14th for the call of October, the journey to profitability and then to the consistency. I have made this call on 2015. That was based on the this concept here. So on the larger time frame, you're seeing this move lower. There's a 50% here. Okay. When we drill down to the daily time frame, and we can see this. We can see this on the move in October here. So there is a sequence of measured moves, right? And even if this measured move here is not perfect, the market still moved lower into the first and second target. Okay, and then it went to test the 50% level that I showed you on the weekly time frame. When we trace from lows to lows, there was a break here. Okay, which means that the longs now that are in the weekly time frame, the longs were here, this 50%. They are interested in pushing this price higher. So the 61% level breaks. That means, as I showed you before, also in the example of the Japanese yen, it means that bears are not longer interested in pushing this price lower. They try here, can you see? They try here to keep pushing this price lower, and then they fail. And when they fail, then we know that the new direction higher in this market, it's the one dictated by the smart money. Now, that money enters that money because the short-term reaction, we know that the long-term move is higher, but the longer-term move is higher. In fact, eventually comes. Seasonally also, we are in that October area where we know that the market tends to move higher. But we need to take into consideration what the smart money is doing, and that money is doing, and that money tries to sell after the dump money, the smart money short has basically gave up on this market. They shorted, they tried to push it lower, but this market reacts higher. And again, dump money added and pushed this price lower. But we know that ultimately the market had traded at 50% level. Okay, so that's an example of applying the Fibonacci timing to these markets. And again, you can review September 14th, 2015, the journey to profitability and then to the consistency. Okay, that was the first move lower. Then another test in October came, and in October the seasonality played very well. In fact, this is the seasonality when you look at the last 20 years of data. When you look at the last 70 years of data on the S&P 500, you get something more like this. So the real low actually happens at the end of October. Okay, so this is it for today. I hope you enjoyed the presentation. Thanks for joining, Adinda, Jerry, John, Mark, Nick, Pat, Tom, and I hope this is useful. I hope you can use this. I use this all the time. And if you have any questions, you can come to Fibonacci Trading, and you can review the website as well. And you can write me an email at fibonacci@gmail.com. So hope this was useful. Thank you very much for joining in today, and thanks to Everstreet for offering the opportunity to talk about this. So the next webinar is going to be probably in September, and probably have 2 webinars every month. So thank you very much, and have a great day. Bye bye now.